Hey everybody, Abdullah Shamari here. Today we're going to be discussing AMC. Make sure to subscribe to my page, crush the like button for the YouTube algorithm, and check out my Patreon link below. You'll get insights into my watch lists, my portfolio, my daily readings, as well as instant posts on my buys and sells as they're happening each and every day. AMC is a well-known cinema company that we all go to and we used to watch videos in. With the COVID pandemic that's occurred over the past year, we all haven't been to a movie theater in probably over a year. Maybe in some parts of the world, certain theaters are open, or in certain cities such as Singapore and some of the Asia Pacific countries, they might have been able to open theaters, and sporadically in various cities around the country. However, overall theaters have been closed for the most part, and also many studios haven't been releasing videos or movies to AMC and other cinemas. As a result, AMC and the various different cinemas have taken a huge hit. They have to continue incurring the costs of their cinemas because they're on leases on each and every one of them. However, they're closing each of those facilities, but they still have to incur those fixed costs that they have to pay to the landlords each and every month. They did get some relief with regards to PPP, etc., and various government subsidies that were given to them. However, overall, they continue to suffer, and it's been a tough time for the company. With the Wallstreetbets movement, the stock has gone up and down, similar to what we talked about on NAKD, as well as GameStop. These stocks have moved up and down due to short sellers as well as retail investors putting money into the stock or thinking that the stock will continue to decrease in price. Overall, the company is in a tough position in that they have a lot of fixed costs. And even when theaters do open back, I think that individuals will go to the theaters, but it will be a short burst of increase in revenue. But however, in the long term, we can see that the studios are starting to move away from theaters, and that theaters will become less and less a daily activity or a weekly activity that people do. However, it will be more like Broadway shows where people will go maybe once in a year, once every few months, and not regularly to a movie theater just like they used to prior to the pandemic. Next, we want to go through the actual stock and see how it's been doing and how it has done over the long stretch and how it's done over the past 5 or 10 years to see what the maximum possible rise in the stock could be, even if we thought that the stock could recover due to the circumstances of COVID ending and people rushing to the cinema, etc. We can see here that the maximum the stock had reached since 2013 is a maximum of about $30 to $33. So this is the max potential that we could see in the stock. And the reason why I say it's the max potential is because at this point in time, when they were at $33 a share, the company didn't have as much debt as it has currently. They've had to incur a significant amount of debt in order to be able to stabilize their business, pay their fixed costs, and be able to pay their landlords for all of the theaters that they lease around the world. As a result, the company has incurred significant debt similar to other industries such as the airlines industry and the cruise line industry. All of these industries have had no customers or less customers, but they have had to still incur the costs related to their facilities. And we can see now currently the stock is trading at about $11 a share. Going into the financials of the company, we can see that from 2017 to 2019, the company has been able to have stable revenue of about $5 billion per year. We can see the steep drop in 2020 to $1.2 billion for the year ended 12/31/2020. We can see from a net loss perspective, they had $4.5 billion of net loss. And again, this is where the debt comes in. They've had to fund that loss with debt because they didn't have enough customers over the past year. We can see in prior years, they were just about break even, 500 million loss, 100 million gain, $100 million loss. So for the most part, pretty much break even with some profit in 2018. From a balance sheet perspective, the company's assets, we can see for the most part have been stable. They're at 10 billion, and 2 years ago they were at 9 billion or just around 10 billion. And then in in 2019, they were a little bit higher. From a liabilities perspective, we see the significant increase. Their liabilities over the past 4 years have more than doubled, and we can see here the majority of that coming from long-term debt. We can see about $12 billion in non-current liabilities, or these are long-term liabilities, with $10 billion being in debt. Previously, it was only $5 billion. So we can see that number has doubled, which makes up the majority of this huge increase in their liabilities. So we can see that their liabilities are higher than their assets, that they don't even have the assets to fund and to pay off any and all the liabilities or money that they owe currently. Lastly, as we always do, going through the cash flow statement, we can see that the company, from an operational perspective, they lost $1.1 billion from operations in cash. So they needed $1.1 billion in order to be able to keep their businesses running. Over the past year, in the other years, we can see they had positive cash flow of $500 million, and the similar in 2017 and 2018. Overall, we can see that the company is not the same company that it was prior to the COVID pandemic due to the amount of debt they've had to incur. From a cash flow perspective, we can see here that the company had to use $1.1 billion of cash in order to fund its operations. The prior years, we could see that they had $500 million positive cash inflow based off of their operations. So prior to the pandemic, they were actually generating cash from their operations, which is good. And we could also see that they were either slightly at a loss or slightly at a profit in the prior 2 years. However, we can see now that they had to use a significant amount of cash in 2020 in order to fund their operations and continue paying off all those landlords related to their facilities. And as a result, they incurred significant amount of debt. So they're not the same company that they were prior to the pandemic. And as a result, any profits that they have in future years, whether it's 500 million or 1 billion, all of that money is going to go not to investors, it's going to pay off their $10 billion worth of debt. So investors are not going to see any of the profits that, even if there was a rush to the cinema after the pandemic, all of those profits are going to go to paying back the debt. Similar issue with cruise lines, similar issue with airlines. There's a lot of debt that they had to incur. This pandemic has tremendously impacted them and their operations because of the standstill for the past year. So as a result, I don't believe that AMC will be able to recover to the $30 range in the future. I think that potentially they can get to the $20 range at most, but more likely than not, they're probably going to have a tough time over the next few years, realize that they're not going to be able to pay off their debt when it comes due, and interest rates increase and they can't refinance that debt, and potentially they'll have to go into bankruptcy, in my opinion. These are my thoughts. Let me know what you think. As always, make money, enjoy life. Peace.